Good day and welcome to your next F6 EXP recording. The next section is taxation of partnerships. I'm sure most of you have done the F4 course or have done a law course along your studies, and you will know that legally a partnership is a legal entity. However, the Income Tax Act does not regard a partnership as a legal entity. They do make provision in the Act for the taxation of a partnership, but the only thing that they say is that each partner is taxed in his individual capacity. I'm not going to go through the legalities of a partnership. You should know this from your F4 course. Normal tax. Again, we will reiterate that a partnership is not defined as a person for tax purposes and is therefore not a taxable entity and not liable for normal tax. The individual partners are, however, liable for income tax on their portion of the profits from the partnership. A partnership does not qualify as an employer of the partners, and a partner cannot be regarded as a holder of an office. This results in the non-applicability of certain sections of the Act, which is any salary paid to a partner is not subject to employee's tax. So literally your partner is a provisional taxpayer. No fringe benefit rules apply. The provision of reimbursable allowance do not apply, and medical scheme contributions paid in respect of a former employee do not apply. Partners' tax. The partnership is allowed to deduct expenses that are incurred in the production of income as any other entity would. So if it is a manufacturing partnership, they could deduct your Section 11 deductions. They could deduct Section 12C if it is a manufacturing entity in the process of manufacture, everything that we have done. But when you come to the bottom line that says profits, and you do not pay income tax on those profits, however, you just split the amount in the profit sharing ratio between the partners, and then it goes to a partner's individual gross income. This would form the gross income of the individual, and you would work out the partner's income tax as if he were an individual. Capital gains tax is, however, applicable every time a partner resigns or retires or a new partner joins. The old partnership ceases and a new one is formed. SARS, however, adopts a fractional approach where each partner is presumed to hold a percentage of the assets, and the percentage interest changes when a partner is admitted or released. Turnover tax. Turnover tax is a new concept. Normally, if you are an entity, you would pay income tax, and you would pay value-added tax, and you would pay capital gains tax, and you would pay every other tax that we have. However, they have tried to simplify this matter, and we have what we call a turnover tax. Where any partner is not a natural person, you cannot elect to be taxed on the basis of a turnover tax. Where a partner is a partner of more than one partnership, you also cannot elect to be taxed on a turnover tax. The turnover or gross income must not exceed R1 million for the year of assessment. And you do not have to be a registered VAT vendor. Dissolution, termination of the partnership agreement. 2 different payments may be made on dissolution. Firstly, the payments for the share of profits earned up to the date of dissolution is a taxable amount. If the partner receives a share of the profits, it will be included in his gross income and he will subsequently be taxed on it. Payment for the disposal of a right to share in the profits. This is seen as capital in nature, so it will not be included in his gross income. However, this may attract capital gains tax. So be careful. The one would be normal income tax. The other, although it is capital in nature, it may attract capital gains tax. And that is all for partnerships. Remember, all partners are taxed as individuals. The partnership as a whole is not taxed. The partnership can pay value-added tax if they have a turnover of below R1 million, with all partners being natural persons and only partners of that one partnership. They can opt to be taxed on the turnover tax system, which encompasses all taxes, not just income tax. Okay, I think that does it for this recording. I will see you at the next recording. Thank you.